Welcome back to Taxes and You. This is real estate investing basics information. One of the things we wanted to continue talking about again is the financing and things of that nature for the purchase of the home, either for your own personal use or for investment purposes. One of the things that comes up when interest rates are high is a thing called points. What happens is the banks normally will charge, let's say the interest rate is 4.5% for a mortgage. That rate is relatively low and people aren't interested in paying points. What a point will do is a point can be paid to lower the interest rate on your mortgage. What happens with points is, and a point, by the way, is 1% of the mortgage balance. So, for example, let's say you buy a house for $100,000, you put $20,000 down. Then what will happen is you'll have an $80,000 mortgage and the interest rate is, say, 4.5%. The bank will offer you the option of paying a point or a half a point or a quarter of a point. And by paying that, they'll reduce your mortgage rate from 4.5% to 4%. Basically, all this is all they do is they calculate the present value of the interest they're going to lose, and they come up with a number, and that's what they ask you to pay. So for the bank, it makes no difference if you pay points or don't pay points. What it does do, though, is it reduces the amount of interest over a 30-year mortgage. The catch to a point, and this is very important, is that if you're going to pay points, you will only get back your money if you're in the home for anywhere from 10 to 15 years. Now, it's interesting to note that the national average for people changing homes, in other words, buying a home, living in it, and then having kids and moving into a larger home, is approximately 7 years. So if you're going to pay points, it's very important that you know, or you're pretty certain that you're going to be in that house for at least 10 to 15 years. There's an easy way to do the calculation just to double check to make sure. Actually, when I bought my first house back in the 80s, the interest rates were at like 13.5%, which is phenomenally high. And people were paying 2 and 3 points to get their mortgage rates down to 10%. And in that case, it was a phenomenal savings. Today, with the lower interest rates, points aren't really that much of an issue. It comes up, it can be discussed, but it's really not as important as it was back then. Also, the points will vary from bank to bank. For example, if you go to one bank and you might pay a point and they'll reduce the mortgage by a half a point. Others you might pay a point and they'll reduce it 0.75%. So the whole thing is that it fluctuates from bank to bank, and so you really do have to compare all of them. An adjustable rate mortgage, we discussed this a little bit earlier. With an adjustable rate mortgage, the rates are almost always lower initially. And the reason it is because the market risk is all on you. See, the problem the banks have with a fixed rate mortgage is that if they give you a mortgage, let's say currently at 4.5%, and let's say that for whatever reason the inflation takes over and the mortgage rates go to like 8%, well, notice your mortgage is at 4.5%. If the bank could sell your mortgage to somebody for 8%, they'd make more money. And so there's a market risk for them in that they actually could lose money by giving you a fixed rate. Therefore, there's much more hoops you have to jump through to get a fixed rate mortgage. There's certain debt equity requirements. Again, all these calculations can be done. But the point is that an adjustable rate mortgage will always be lower. The problem with adjustable rates is that they will go up. Almost invariably, they will go up because as the market rates go up, the adjustable rates go up with them. Most adjustable rates have what's called a ceiling, like this is the highest it will go, and a floor, this is the lowest it will go. There were actually some people who got adjustable rate mortgages back in the 90s, and as the interest rates came down in the 2000s and whatever, their mortgages actually went down in price because the market went down, so their adjustable rate went down. But again, there's a floor, so it doesn't go too much lower. The ceiling is what you have to be the most concerned about. For example, if you can't afford a 4.5% mortgage, okay, you can probably get an adjustable rate for 3.5, almost a full percent lower. And again, that fluctuates depending on the market, so that's not a standard 1% difference. But the point is that you might be able to get 3.5%. The problem is the ceiling on your adjustable rate mortgage might be 6%. So what you have to be concerned about is how soon can it get to 6%? And again, this is a calculation you have to do with someone to figure out at what point do I lose the house? Like maybe you can afford 3.5%, but the highest you can go is 4.5%, okay, in the future. Well, at that point, that means when you hit 4.5% on your adjustable rate mortgage, you need to refinance the mortgage. The problem will be is that at that moment, the fixed rate mortgages will then be 5.5%. So be aware that adjustable rate mortgages are very good because it keeps your payments lower. They're bad because there's an amount that it can raise, and you can end up actually losing your home because you can't afford the payments. Now, adjustable rates have to be tied to something. In other words, if something else goes up, the adjustable rate goes up with it. In the past, it was always tied to the federal rate or the prime rate. So, as you've heard, the Federal Reserve has a prime rate, and it's talked about constantly in all the financial programs. Okay, and the prime rate is relatively low right now, so adjustable rates should be relatively low. They've also tied it in the past to the Treasury bill rate, and again, that's the rate at which the government lends money, and those rates are also relatively low. But what's happened is, and one of the things that caused this terrible financial crisis with bank mortgages, I don't know, I'm sure you remember this, in the early 2010s, we had that meltdown of the mortgage industry. Okay, that whole meltdown occurred because of adjustable rate mortgages. What happened was people were buying mortgages and getting adjustable rates, which they knew would keep that payment lower. But as the rates rose, the people couldn't afford to make the payments, and all of a sudden these mortgages were all going bad at the same time. The reason for this is that even though the federal rate was constant that entire time, because our economy was struggling, all of the banks, all the financial institutions have now tied adjustable rate mortgage to the London International Bank overnight rate. It's called LIBOR. LIBOR is the rates that's charged between banks to lend money from each other. Now, the reason that's important is that the LIBOR rate is an international rate. It covers the entire world. And so therefore, if something happens in the Middle East, the LIBOR rate will go up. If something happens in Russia, the LIBOR rate will go up. If something happens in Ukraine, the LIBOR rate will go up. Because anytime there's volatility or danger, the LIBOR rate will increase. Again, this is not your father's mortgage rate. This has changed now, and everything is tied into the international market. Problem was people who signed adjustable rate mortgages back in the early 2000s and even the 1990s were not aware that they were being tied into the LIBOR rate. In fact, there's a lot of people still don't even know that it exists or what it is. The point is that adjustable rate mortgages are now much more volatile than they were in the past, and you have to take extreme caution in using them. Okay, so when's a good time to use an ARM, an adjustable rate mortgage? The first one is when you know you're only going to be in the house for a short time. Like, for example, let's say you've taken a job someplace and you're just trying to find a house to move into. You're going to store some of your furniture and whatever until you actually find the house you want to live in. My wife and I actually did this when we moved to Washington, D.C. We bought a house that was just like a stopgap house. We needed someplace to live until we could find a house in a subdivision or a town that we wanted to be in, but we didn't know too much about the D.C. area. So you can buy a house, you get an adjustable rate mortgage, everything's relatively inexpensive, the rate's low, and you know you're leaving in a short period of time. By the way, of course, that means when you go to get your next house, you pay off that mortgage, and it works out quite nicely, all things considered. Another time is if you're expecting to get a large sum of money in the near future. For example, let's say one of your relatives died, or some relative died, a parent, grandparent, or whatever, and you're expecting to get a large sum of money so that you can put a larger down payment down on the house. Because again, remember, the qualifications for a fixed rate mortgage are higher than they are for an adjustable rate mortgage. And one of the things that's always considered is your down payment. So if you're going to be getting a large sum of money, you might want to do an adjustable rate for a short period of time, even 2 years, knowing that, oh, and by the way, the ceiling and the floors are usually annual and total. So for example, a ceiling might be, well, we will only increase your mortgage 0.5% every year for the next 10 years, which means there's a ceiling of 5% increase. Or they might say we can only reduce it 0.1% for 8 years, which means the floor is only 1% lower. The point is that during that time, the rate's not going to go up that much, and so therefore you'll be able to get out of that adjustable rate mortgage and into a fixed rate mortgage. Also, if current rates are really high, which is not present at this moment, but back in the early 80s, when the economy was really in a tank, and that's when we had the 13.8% interest rates, you could get an adjustable rate for approximately 9.5% versus 13.5%, which was an incredible difference. And the difference in money savings was well worth the risk. Plus, and this was the key, we had a new president had been elected who promised to do some changes to the economy, which supposedly was going to lower interest rates and all those things. And people took him at his word. And actually it did work out quite nicely at that time. Also, there's a thing called a balloon mortgage. Some adjustable rate mortgages are balloon mortgages. And what that means is you basically, you get a mortgage for a house. Again, we'll just use that same example, $100,000, put $20,000 down, get an $80,000 mortgage. And what happens is you get an adjustable rate mortgage, but it balloons at the end of 5 years, which means at the end of the 5-year period, the mortgage ends. By the way, it's amortized over 20 or 30 years, so the payments are still low. But what happens is at the end of the 5-year period, the mortgage ends, and you have to go into the market and get a new mortgage for your home. Again, you normally only do that if you believe that interest rates are going down in the future. That's one of the things. And balloon mortgages were very, very popular or used frequently in California during the time of the great housing boom out there, where prices, a house would be, you'd buy a house for $200,000, and in about a year and a half, that house would be worth $400,000. Well, if you had a balloon mortgage, that was no problem. You could sell the house, pay off the old mortgage, and then buy another new house. All right. The other times you want to do an adjustable rate mortgage, and this honestly, is when you can't get it any other way. In other words, if you really can't qualify for a fixed rate mortgage for any number of reasons, then it's really fantastic to be able to at least get into a house with an adjustable rate mortgage. But again, I caution you to be aware that when you get to that ceiling, you have to be able to make that payment at the ceiling. Now again, remember the ceiling, you're not going to hit that for 5, 6, or 7 years. And hopefully you'll be getting raises, or there's other things that change in your life where you'll be have more income. But the point is you have to be aware that you could end up losing the house with that. The other thing too to remember is I've seen clients say, oh yeah, my uncle died and I'm expecting to get some money, so I'll do an adjustable rate mortgage because I'll have the extra money for a down payment later, and then I can get a fixed rate. And it turns out that the uncle didn't leave them anything. So all of a sudden, all the plans they had made just went up in smoke. Again, as we talk about in our budgeting seminars, the only thing you can really count on are your expenses. It's almost impossible to count on income in any way, shape, or form because there's always a chance that it doesn't materialize. There's other things to consider when you buy a house, of course, and one of those is, will you need to make improvements to it? If you remember, I talked in an earlier episode about a home inspector coming in and looking at your home. Well, one of the things that will happen also is they will come in and they will tell you, okay, for example, with the home I recently purchased, or the last home I purchased, we had the inspector come in and he said, your roof's going to be gone in 5 years. You're going to have to replace it. Okay, well that's anywhere from $6,000 to $20,000 depending on how you finish the roof on a normal house. So know that you're going to have that cost. Now the reason I mention it is that you have the opportunity at that time to borrow the money when you purchase the house and add it to the mortgage to repair the roof or to do any major types of repairs. This is also true for electrical and things of that nature. Like if you're buying a really old house, a house built in the 1950s, most of them are still on, they don't even have circuit breakers. They still have fuses. Most people would suggest that you upgrade that and put in circuit breakers. Again, the improvements can be rolled into the mortgage. If you don't do that, then later on you have to get what's called a home equity line of credit. But again, the problem there is you have to have equity in the home to be able to do that. Okay? A couple other things too would be the furnace. You have to be careful of the furnaces, the hot water heaters. Hot water heaters only last an average of 8 to 10 years. Also drainage. In some parts of the country, drainage is a very important issue in regards to water in the basement and things of that nature. Also depends on how the house was constructed. In the area I am now, most of the basements are block basements where they actually cement blocks together. And while that's a decent foundation, it tends to leak. If you have a lot of rain, a lot of water, a lot of drainage around the house, you have a tendency to leak. And most of the homes that I know in this area have sump pumps, which actually pump the water out. It's important to be aware that if you're buying a house in that area and it doesn't have a sump pump, well then obviously that's going to be an expense you will have to incur. And by the way, we're currently looking at putting a sump pump in our house. All right. Also, if you have any retaining walls, again, there's a tremendous amount of retaining walls in the area where I live, and retaining walls have a tendency to fall. Be careful of that. I actually had a neighbor when I bought a house who started digging into my property because his retaining wall was falling. So he was digging into my property to have a base for his retaining wall, which actually, and I'll say this, is the right thing to do. The problem was he forgot to ask me, and secondly, as he started digging, my retaining wall started to fall. And so we resolved it amicably. But the point is that retaining walls are very expensive to replace if you need them in certain areas. Again, and the most important thing is to remember is that these repairs can be rolled into the mortgage. Also, one of the things I personally had to add to a home was air conditioning. The reason being is that I have several members of my family have allergies, and air conditioning is very important to be able to take out some of the pollens and things of that nature. I again rolled that cost of air conditioning in the house into my mortgage, so it made it really doable. The other thing too about what can I afford, don't forget that when you buy a house, all of a sudden something is going to happen that you've never had to do before, and that is you're going to have to maintain the home. You're going to have to do repairs and things of that nature. There's a whole bunch of things that you'll probably have to buy for the first time. As silly as it is, a lawnmower and whatever, depending on the size of the yard, that could be quite an expensive undertaking. I would not recommend that you throw any tools or anything of that nature into a mortgage, because you will pay 3 times more for that item than if you just pay for it or even use a revolving credit card and pay it off on a shorter time. Also, the other thing that's relatively expensive that people forget about is all of your shrubbery and trees and plants and things that you're going to be putting around the house if it's not already there. And finally, there's a number of tools that you'll have to buy. Again, I recommend estate sales and things of that nature. I got at least half of my tools from estate sales just driving around. The ones that are tools that I highly recommend that you buy are plumbing tools. It turned out that almost every home I've had, I've always had to do a lot of plumbing things. All right, now I want to switch and go from that, what can you afford? Again, all those things have to be taken into account when you're looking to buy your home and figuring out how much money you have to be able to make the mortgage payments, which include, again, refresh your memory, the principal, the interest, the real estate taxes, and your homeowner's insurance, the PITI payment. Be aware that that has to be made every month. There's like nothing you can do. In fact, if you're on the verge of bankruptcy and you can't pay anything, you always want to pay your mortgage, because no matter what, okay, if you pay your mortgage, you still have a chance. You still have a chance in all the different legal courts and everything and all that stuff. It's very important to pay your mortgage. The reason is that if you do go into bankruptcy and your mortgage has been paid, they will allow you to keep your home. they will allow you to keep your home as long as the mortgage is relatively current. Okay, I want to get into the investing part now a little bit about for people who are watching these episodes for investing in real estate. If you're investing in real estate, there's a tax form called a Schedule E. On it, there are listed 3 columns, A, B, and C, and that's enough for 3 different rental properties. I have several clients with like 13, 14, 15, 16, 22 rental properties, in which case we have to file 6, 7 Schedule E's to list all of the properties. There's a word that's in the Internal Revenue Code and the regulations that's very important, and it's called an activity. And so what happens is this: if I have 3 rental properties, I can group them into any activities that I want. In other words, let's say I have 3 rental properties. I can take A and call it a separate activity, B and call it a separate activity, and C and call it a separate activity. Or I could call A and B one activity and C a separate activity. And you can actually group any of those 3 properties any way that you want initially on your first tax return. Now, the reason this is important as an investor is that if you want to take losses for your rental properties, you have to be what's called active material participant in that rental property. If your AGI is over $100 and some thousand, what happens is if you have any losses, they are suspended. In other words, you cannot take them. If you don't, even if you don't have that material participation, then none of it's deductible. It doesn't matter what your income is. So it's very important that when you initially group these rental properties into activities, that you discuss this with your tax preparer, okay? Because again, without that active participation, material participation, you will not be able to take your losses in the first few years. And again, the most important thing, I mentioned this earlier, when you're buying rental property, the most important thing is appreciation. It doesn't really matter if you have negative cash flow, assuming you can afford the negative cash flow. But the point is, negative cash flow should not be an issue for you. The issue is, will the real estate appreciate in value? Because your goal is to take ordinary deductions and then be able to sell that house at capital gains. Some of the requirements for this material participation, this active participation, according to the regulations, are that 1, you have to participate in management. Well, that's usually not a problem if you own the property. The second one is you have to provide or arrange to provide for services. So for example, if you have a rental property, you could actually pay somebody to mow the lawn for your renters. Other people say, no, you have to take care of the property yourself. But the point is, if you provide services, that shows that you're active there. You also have to be active in a significant and bona fide sense. In other words, if you're claiming you're the manager, but you hire a relative to take care of that, okay, then in reality, you're not active, the relative is. Notice this also implies that more than one person can be active. In other words, you could have a husband and a wife that are working jointly on this property. You could have, and I've had this happen, where you have a parent die, the second parent passes away, and the 2 children decide not to sell the parent's home, but to turn it into a rental property because it's a very nice area. They'll get substantial rent. They have no mortgage. It's going to be a positive cash flow, and it changes it into an investment property. Both of the relatives, both of the children, can be active in this entity, in this rental, as long as they both do management types things. Okay. One of the things that's important for the activities also is this, and that is if you have passive losses, or I'm sorry, if you have suspended losses or passive losses, you can only deduct them when you get rid of an entire activity. So if you remember previously, I stated if I had 3 activities, A, B, and C, if I sold any one of those properties, okay, and I had passive suspended losses, what would happen is I would be allowed to take the losses for property A. Okay. However, if they were all one activity, A, B, and C together, then what would happen is if I sold A at a gain, I would not be able to take the losses from A because I still have B and C. Now, I know this is a little complicated, and I appreciate that, but the point is something that you have to be somewhat aware of when you meet with your tax preparer so you can talk about this when you go to the selection of the activities. I have an example in the materials, and without a flip chart or something to write this all out, it's a little complicated to follow. So I'd like to just overlook this right now and tell you that if you have this situation, you need to be in touch with us, okay? Let's see, for the Schedule E, the name of the taxpayer's active should be at the top of the Schedule E. Now again, as I mentioned, normally when you do tax forms, all the tax software is set up so that we put the husband first, the spouse second. If there's no husband, then it's the taxpayer first, okay? And then dependents or whatever. On almost all tax software, the first name that's on the tax return will be listed as the active member. However, if you have, let's say, a husband who is professional, working, whatever, CPA, doctor, whatever, and then you have the spouse who's doing real estate on the side as something that they're trying to work together to build an investment portfolio of rental properties, you would want to assign the spouse as the active person because they're the ones who are actually doing the work, and they should be listed at the top of the Schedule E. I've actually seen audits where the losses were disallowed because the professional was listed as the active person, but they couldn't meet the time test. Okay, being active, being bona fidely active in that thing. Okay. By the way, and as I stated, it could be joint. If it's joint with the husband and the wife, or the taxpayer and the spouse, then what happens is the taxpayer and the spouse would be listed on the Schedule E. Again, the taxpayer only would probably be listed because of the way the tax forms are set up. But it would be noted that it's jointly worked by both people. Okay, rents and royalties. If you rent to anyone for a period of time, any corporations, any businesses, or anything of that nature, they're supposed to give you a 1099 miscellaneous, which includes rents. Okay, this is very important. Rents and royalties. Royalties also, by the way, I'm sure you're all familiar with Marcellus Shale Oil and all the things going on with that. One of the things that happens is people actually rent their fields. Okay, they rent the use of the fields where people come in and they actually drill the holes, and then they rent the space where they put their pads and they put all their equipment. That's different from the royalties that people get from the oil that comes out of the ground, or the gas or whatever that comes out of the ground. Both of those are to be handled separately. One is a rent and one is a royalty. So you would actually have two column A for the rents and column B for the royalties for that type of entity. Okay, be careful because sometimes royalties can also mean for writing books. Okay, if you author a book or you author an article, or you do TV videos and you get royalties for these things, one of the things that happens is that does not go on a Schedule E because that's earned income. That's something you earned by working, and so what happens is you would end up putting that on a Schedule C. That's a little beyond the parameters of what I'm talking about, but I want you to be aware that there's at least two types of royalties. Okay. The other thing about rentals that one of the things people don't know about is that you're allowed to rent your home, your own personal home, or any building for 14 days or less, take all the money you want for it, and pay no income tax on that money. Now, additionally, all your expenses for that 14 days are not deductible. But the key is, and this is the important part, the key is that it's very important to rent your house for a special event. For example, in the Olympics, when the Olympics were held in LA, wealthy people who had $5 million mansions, who had servants, who had extra cars, they were leasing their homes to billionaires or other millionaires from foreign countries to come in and attend the Olympics, live in their home, and they were charging them millions of dollars to do that. All of that is tax-free. What other things happen that are only 2 weeks long? Well, there's a number of things that apply to this. One would be the U.S. Open, the golf tournament. It's a 5-day event. It travels around the country. It goes to different places. If you had a really nice rental property or a nice home in any of those areas, then what you could do is you could actually rent your home to someone else from a foreign country and be able to take that money completely tax-free. Again, the chances of that happening are small, but you need to be aware of that. Actually, in the city I'm living in now, we had here the Special Olympics, and several of my clients actually rendered their homes to members who were competing in the Special Olympics, and it turned out to be cheaper than being in a hotel. And everybody was happy about that, the people that came and the people that rented. All right. Also, you're also allowed to go and use your rental property for 14 days yourselves. Remember we said you want to own the home someplace that's going to appreciate. Well, again, that's normally one of the easiest places for that to happen is a vacation area, like Nags Head or Ocean City, Maryland, or any number of places along the way. Okay, South Charleston, South Carolina. I mean, we could list everything. Think of any place you'd want to go on vacation, and that's a good example. You're allowed to use your vacation home, your rental property for 14 days completely tax-free without any problem, and it's still considered a rental property. Again, if it's less than 14 days, you don't even have to adjust for personal usage. The other trade-off is you're also allowed to use it for 10% of the rented days if it's more. So for example, let's say you actually rent a property for 300 days, then you would be allowed to use that rental property for 30 days and not have to, and still be a rental property and not have to adjust for the personal usage of the property. The important thing to remember is that those 14 days, work days, do not count. In other words, you might have to go to your rental property in a vacation area for a couple of days at the start of the season to clean it up, get it ready for people who are going to come in. Those do not count as part of the 14 days. All right. And the thing is that the reasonable work days, there was actually a time where I had a client that actually had 14 work days. They had to go and clean up, and we were audited, of course, because 14 is a little bit of a high number for work days. But what had happened was they'd had a hurricane, and so they had to go down and do a little more work, and we actually won that. And there have been court cases where reasonable work days are allowed. Okay, what are some of the expenses you have as in a Schedule E for a rental property? Well, the first one, of course, is advertising. You have to put it in newspapers, bulletin boards, Facebook, Craigslist. I know some of those are free, but they're still, by the way, using Craigslist and the internet justifies being able to write off part of your internet fees as a business expense instead of as a personal non-deductible. Also, any auto or travel. In other words, if you travel to the rental property, the mileage is deductible, the business mileage, which currently is at 56 cents a mile. I probably shouldn't have said that because that dates the video immediately because they change the number every October. But the point is that it can be substantial money, especially if you have a rental property that's in a vacation area and you have to drive there to take care of it. You're actually able to write off the trip there. If it's more than a one-day trip, you'd be able to write off the hotel on the way there. If it's so far away you have to fly, you're able to write off the airfare because that's travel to take care of your rental property. It's important to keep track of all that. Also, if you're home and the rental property is far away and you drive around town picking up items that you're going to need to clean the rental property or to do maintenance on the rental property, or if you drive there and you get there and you have to drive around to get parts or materials, all of that mileage is deductible, and it's very important to keep track of that. Also, a lot of people that rent actually use post-office boxes, P.O. boxes, to receive information and checks and stuff from people. Therefore, a P.O. box could be deductible also if you have a rental property. Any tolls that you pay. For example, I have clients with rental properties in Nags Head. Well, if you go from anywhere to Nags Head, there's tolls almost every place. At some point in time, you have to pay tolls. Those tolls would be deductible also. If you do fly, let's say you have a rental property in San Diego, if you drive to the airport, the trip to the airport is deductible. The parking at the airport is deductible while you're gone. Again, remember, this is when you are doing business there, not when you are using the property for your own personal vacation time. Okay, it's very important. You don't want to commingle or mix those things. Another thing, too, would be cleaning and maintenance. If you pay anyone to clean it or if you buy cleaning supplies, all that would be deductible. Commissions. If you have a rental property in Nags Head, you will almost always have a real estate agent who's managing it for you. So you'll be paying a commission, 5-6% of the rent or whatever. The point is that that would be deductible also. And by the way, they know it's deductible. So the commissions in high-end rental areas, vacation areas, are higher than they are, say, outside of a city or something like that. Insurance, any type of insurance you have on the vacation or the rental property, vacation property, is deductible. The house insurance, you probably have to have liability insurance. Most people recommend an umbrella policy, which covers not only the vacation or the rental home, but also your personal home and all the things that you have. Okay. There's also other types of insurance that could be included. At least where I live, we have water line insurance, sewage insurance, gas line insurance, telephone line insurance. If you have any of that type of insurance, it's usually included, though, with your utility bill. And again, all the utilities are deductible for a rental property. Also, legal and professional fees are deductible. So if you hire a CPA to help you do your taxes or whatever, that's deductible. Attorneys to help set up the lease agreements and whatever. Though sometimes the real estate managers that you hire will have lease agreements that are kind of like standard for their area. By the way, I'd still highly recommend you read that thing or have an attorney read it, just to make sure that you're not endangered in any way, shape, or form. Okay. Then, of course, there's also management fees, which we discussed a little bit in concerns of in regards to taking care of it. One of the things that I throw out to you, and this is for high-end individuals, when your kids go to college, there are people who have loyalty to a certain college, and they have 4 or 5 children, or even 2 or 3 children. And we actually did this with a CPA firm that I worked with in the Washington, D.C. area. We actually set up I'm trying to think of a word, a rental service for our clients. What would happen is we would have a client, and I don't know if you've had any kids who go to college, but to be in the dormitory at a large college is approximately $10,000 a year. Works out to like about $1,000 a month. Okay, well, what we had is we had clients who had money, and they would go to these college towns. The one I'll give you is Georgetown, because it was in D.C. area, which is a very, marketable area. In other words, there's always appreciation in D.C. And what they did was they bought a townhouse in Washington, D.C., a 4-bedroom townhouse. And what they did was they then allowed their child to live in one of the bedrooms and attend Georgetown University. And they also, through our service, we were able to hook them up with other people who were going to Georgetown University, whom we knew the family. We knew that everybody was on the up and up, and they would rent out the rooms to each of the kids for like $800, $900 a month. Okay, now that was still cheaper than living in the dormitories at Georgetown University. And what happened was it allowed our client to buy this rental property because the students were making the mortgage payments. The other thing that happened that works out very well is you then have your student, your child, become the manager of the rental property. You're now able to pay your child to actually manage the rental property. Additionally, you would have to go to see the rental property, hopefully on Parents' Weekend, if you get my drift. The point is that it opens up a tremendous amount of tax planning opportunities. Okay, then what happens? Okay, so the kid goes through freshman, sophomore, junior. And by the way, I'm so old that it used to be that when you went to college, the first 2 years you had to live in a dormitory. It was required. There's no questions asked. But currently I found that a number of universities don't require freshmen to live in dormitories. So this opened up the ability to be able to do more of this. And then what we actually did was when that child would get ready to graduate, we would do one of 2 things. We would either hire another student manager from the 3 students that were there. And by the way, we never tried to have them all be juniors, all be seniors, we tried to have different groups so that there would always be a kid that would be there from the previous year. And one of the clients said, well, I'll just ask him to be the manager. Because remember, they had met these people, they had gone to visit their own child, and so therefore they met all the tenants. And again, they knew some of the tenants from our CPA firm because we had discussed all this with them and set up these arrangements. And so they would hire some of those kids to manage the building. Until when? Until the second child went to Georgetown. And then they became the manager, and we just repeated the process for the next 4 years. After we did this for about 3 or 4 children, we're 20 years down the road, they were done at Georgetown. So what happened? The parents then sold the property at a tremendous profit, okay? And it was a win-win-win-win-win situation, okay? I mentioned this only because there are some of you that could probably take advantage of that, and it's important to be aware that that type of planning is available, okay? Let's see, the mortgage interest that you're paying at a bank, that's really nice. You're going to get a 1098. Then what'll happen is you'll take that and it'll go on to Schedule E as a deduction. The real estate taxes will be a deduction. Utilities will be a deduction. All those expenses if you're paying them. Also, when you sell, you have the opportunity when you sell or when you buy to have the seller finance it. There's a lot of times when the seller's like, currently the interest rates in banks is like 0.5%. Also, the market is going up, all right, but the rate of return on the market's still about 3 to 5%. Well, somebody might just as soon be happy taking a 4% fixed rate based upon a mortgage of something they're selling, and they can do a seller finance. If that happens, then it would be an installment sale, which is recorded for tax purposes. But what would happen is you would then be able to deduct that interest, or it would be interest income if you were the one selling. Okay. Also, you can get loans from other non-bank parties, which could also keep the costs down depending on what it is. The repairs for a rental property are one of the most examined areas for the Schedule E. The reason is the government wants you to capitalize it, because if you have a rental property and you do repairs of any size, they normally go over, it's supposed to be depreciated over 27 and a half years versus expensing. So it's just important. It's the rule of thumb that the IRS, they kind of let slide. If it's under $500, you can expense it. But if it's over $500, you really have to document whether or not it improved the home in any way, shape, or form. Okay? The point I make too is just be reasonable. If you're doing, like for example, when I bought my house, I told you I had to replace the entire roof for $20,000. Well, what if there was only a section of the roof that was bad, and it was only going to cost like $3,000 or $2,000? The point is that if it's less than the full price, there's a chance that you could have that it's really not improving the property. You're just repairing something so that it's equal to what it was before. There's a bunch of court cases in regards to all this repairs and maintenance. I won't bore you with them all. The bottom line is that as long as we're reasonable in regards to the repairs, it's usually not an issue. Some of the supplies that people forget about when they're doing rental properties are, I know it sounds crazy, but it's important to be aware of all these. I have another seminar called Nickels and Dimes Add Up to Dollars. And these are some of the nickels and dimes to be aware of. You have like light bulbs. If you're buying throw rugs and stuff like that, if you have the garbage cans, the bags, the lids, all that stuff, any cleaning supplies that go in there. Also any small minor repairs, so the thing, door locks, if you change the keys, you make copies of the keys. And I have to warn you, that was one of the major issues, one of the major problems we had with a lot of the rental property, especially student rentals, was we weren't getting the keys back. And that's very important because you don't want other people to have keys for the home. You don't want them floating around campus or whatever. Okay? Again, there's a line on the Schedule E for taxes. Those are for real estate taxes. What if you get an assessment? For example, and by the way, this is also true for your personal home, but normally people can't deduct anything for their personal homes, but this is important for rentals because you might be able to deduct it. This actually happened to a client of ours. They decided, they were in an older neighborhood, it was a very nice house, and they decided to put sidewalks in the neighborhood. And all the neighbors wanted it until they realized that they got hit with assessments of anywhere from $5,000 to $10,000 each to put in the sidewalks. The question becomes, are those assessments taxes? And the answer is no, those are not taxes. An assessment to make improvements to the property is actually an improvement to the property, which means you now have to take that $5,000 to $10,000 and depreciate it over 27 and a half years. So be aware of that. Some people have tried to take the assessments. There's also some local taxes which I don't want to get into, but like there's actually in some cities there's what they call a gross receipts tax. So for example, and it's in millages, which is in tenths of percentages. It's like tenths of a percentage. So for example, let's say you took in $10,000 in rent, okay, then you would have to pay a $100 gross receipts tax to the locality. Just be aware of that and check again with the attorney or the CPA in the area to make sure that you have that right. Another line is utilities, and utilities are gas, water, electricity. I've seen the phone put there, the phone costs. For example, again, if you have a student manager in the house, your child, you have to have a phone so that you can reach them. That phone would be deductible on the Schedule E as a business expense. But again, personally, I like to take phone and put it as an office expense, not as a utility. Okay. Also, the cable television. Is the cable television deductible? Okay, for your own personal residence, of course not. But for a rental property, it would be 100% deductible because it's one of the things that make your house rentable. Also, of course, internet access or Wi-Fi would be deductible. There's other expenses that you can take also. There's a line that says other expenses, and this is where I put office expenses. The other thing, too, that you can put in there could be business use of the home. In the business use of the home, what happens there is you actually have an office in your home, but that's an entirely different seminar. But it's basically, you take square footage of your office versus the square footage of your house, and now you're able to take part of your deductions for your own personal home on the Schedule E as business use of the office and home. There's two major requirements for business use. Number one, it has to be exclusive use. In other words, if you have, the room has to be used exclusively for the business. And number two, you have to have income. So there might be a problem with that in regards to a Schedule E because you might not be generating income. But listen carefully. If you don't get the deduction for business use of the home, you are allowed to carry those expenses forward into the future. As a quick aside, I had a dance studio that was in a basement of a home, and the lady, she was actually doing the Hawaiian hula. She was a world expert and lived in the DC area, had a townhouse, and her basement, her bottom floor that opened up to the parking lot, was actually a dance studio. And we did business use of the home, but she never made enough money to take the deductions. And we just kept calculating them and calculating them. And by the way, her husband had a very nice job. So trust me, they weren't suffering. But the point is that about 7 years after she started this business, she did her class, her school, did a hula dance in a mall in the DC area. And a senator from Hawaii was so overwhelmed at how perfect it was compared to what he had seen as a child in Hawaii that he contacted the school and he set up for the Hawaiian history, and he got them a grant of several $1,000s to be able to continue the school. And also, and by the way, the grant was taxable, but what happened was it was so much money, and we were able to use all those expenses in the past to offset all the income. So it worked out very well. She was very happy about that. The other thing, too, about the office and home is that it includes all the things. Like if you have a desk, if you have a computer, if you have a printer, a filing cabinet, a phone, a fax machine, a copy machine, all those things will become deductible if they have a business purpose. And again, running a rental property would be considered a business purpose. Okay? A couple other things, office supplies. People forget about this kind of stuff like pens and pencils. Again, I know it's not very much money. By the way, you could also have advertising put on, but then they would become an advertising expense. The point is that there's a lot of different little things that you buy that you use in your office. Paper clips, all those things. Again, I appreciate it's not much money, but nickels and dimes add up to dollars. There's also the office phone. Also, if you have a cell phone, if you have a cell phone, be very careful because you have to account for the approximate usage in regards to the business and rental property. If you have, I have clients that have the one that has 18 rental properties, he gives all those people his personal cell phone. Okay, well, I would say at least half of his calls that he gets every day are from the renters. Well, so we deduct half of his cell phone expenses on the Schedule E. Postage, if you mail out bills or do anything like that, or if you respond to any kind of thing, all that's deductible. Again, even in your own home, again, if you're using the internet for business purposes, then again, a portion of your internet would be deductible. Let's see. The other thing too is, let's say that you don't have business use of the home. In other words, in that room that you don't have exclusive use. So in that room, you actually have like a bed where people stay when they come and visit you. Okay, listen carefully. We now have, because of that, we've lost the utilities, we've lost a number of things. But listen carefully. The desk is still deductible. The computer is still deductible. There's still a lot of expenses. The portion of the cell phone is still deductible. You still have a number of expenses you can deduct. You just won't be able to use that portion of your home. Okay? And by the way, if you have 13 rental properties, what do you do with those expenses in the office? We actually prorate them over all the different properties. All right, we finally got through everything in regards to basics on buying and selling a home. We tried to talk a little bit about points and adjustable rate mortgages today. We tried to give a little background for investing. The most important thing to remember investing, again, is that you have to have appreciation. Without appreciation, it's useless. I think I said this in one of the other episodes. When it comes to rentals, appreciation is king and cash is the queen. The idea is to make sure that your cash flow, you can handle the cash flow, the negative cash flow the first few years. But the bottom line is that after approximately 5 years, the rents will more than exceed all the expenses because the cost of living just has always increased at approximately that rate. Thank you so much for your time.
I grew up in a sports family. From a very young age, I was exposed to sports in a great way. My uncle was on the first pro basketball team in Pittsburgh, the Pittsburgh Ironmen. My cousins played baseball in the Army. I got to see them pitch at Fort Knox in Louisville, Kentucky. And my dad, of course, that was my hero. He was a basketball referee for over 30 years. Met a lot of great people. Have any of you ever heard of George Couples? He was a man who used to call our house and schedule my dad for City League basketball games. Just been a passion in my life, and as I got older I found out about horses, and I ended up owning a stable. And I was asked to be on a sports show with Roger Houston called the Meadows Racing Network. Watching Roger Houston direct and even produce this show. And when we were done, I said, boy, that'd be something great. Maybe someday I could have a TV show. Back in 2011, I had a conversation with some friends about sports that piqued my interest in how could we start a sports talk show on TV? Well, I found out I could go to public access TV in Bethel Park and I'd be able to produce my own sports talk TV show. The great thing about doing 2 sports talk shows on BPTV is I can share my passion about sports with thousands of people every week. If you are passionate about something that you would like to share with the community, I encourage you to come to BPTV and produce a show like I do. I'm Al Levine, volunteer producer of Pittsburgh Sportsline on BPTV.
My work over the past decade with college graduates exposed 2 troubling patterns. First of all, too many of the applicants that were seeking a degree were simply unprepared. And secondly, too many of the college graduates, once they finished, simply lacked the skill set that employers were looking for. In addition, Many of the college graduates now are just drowning in unprecedented levels of school debt. The school debt has reached the $1 trillion mark, which is now second only to home mortgage debt. This perfect storm, if you will, of rising school debt and the skill disconnect between graduates and employers was the motivation for my book, Joe Barista, Ph.D., which highlights the state of American education in the 21st century. It chronicles the educational struggle and journey of a young man who grew up deep in the heart of the Appalachian Mountains, only to find himself an overeducated, experience-deficient graduate who was saddled with a mountain of school debt and no viable job prospects. I also realized through this time working with college graduates that many of these issues could be avoided if we could simply start the career development conversation at the secondary school level. This led to the creation of the TV program, Your Future, Your Choice. You know, there's an old adage, think global and act local. Well, local for me is BPTV. The process was surprisingly simple. I came in and pitched my idea to BPTV, and once accepted, we were off to the races. David Cable and his staff are professional, accommodating, and creative. I literally tell them what I want, and they make it happen. I'm Emmanuel Romanis, Principal Consultant at Forward 21 Career Consulting, and the creator and host of Your Future, Your Choice on BPTV.
My love of books goes way, way back, and that's why working here at the Bethel Park Library is such a perfect fit for me. I remember fond memories of my childhood, reading to my younger sister some of our favorite books like The Pokey Little Puppy or Mickey Mouse's Picnic. As part of our bedtime routine, we would be on our bed, before we fell asleep, reading chapter books together and all taking turns, sharing chapters from Little House on the Prairie or Anne of Green Gables. As we got older and we were able to read it on our own, we would still read aloud together and we would share chapters. We'd take turns, we'd pass the book around. I stress that to families today, the importance of reading aloud and sharing books as a family, because not only does it create those wonderful memories that you always have, but it's so very fundamental to the reading process and to the learning process. Picture books have always been my favorite. So again, working here at the library is just wonderful, and it's the perfect fit because now I get to share those happy memories and I get to share the awesome picture books with kids. And kids of all ages. I love doing shows on BPTV such as Book Nook because again I'm sharing my love of books with kids at home and hopefully encouraging them to come in and then check those books out. And it does work. I've seen it happen. I love when kids run in here the next morning and say, I just watched you on TV last night, or when a parent is with that child saying, hey, we're here to check out that book that you read on the last Book Nook show. That's great. That's how we know it's working and our purpose behind the show is being fulfilled. It's also especially rewarding to me to hear of not only people watching it and viewing it with their kids in their homes, but maybe also using it in their classrooms. I have a lot of friends who are teachers, and we've connected again via Facebook, and a lot of these teachers are telling me that they're airing Book Nook in their classrooms and sharing it with their young students. So that's especially rewarding to me. Patrons who I've become very close with, friends with, who have moved away, and they were sad that they were no longer going to be able to tune in to check it out, but lo and behold, now they can because, again, the BPTV staff is so wonderful, and they upload our episodes to YouTube as well, so now she watches them on the web with her children in Kentucky or wherever it might be. So it is very, very rewarding. We're not only sharing these stories, these special books with kids here in Bethel Park, but we're sharing them with kids across the United States. My name is Elaine Volpe, Head of Youth Services at the Bethel Park Public Library and producer of Missy Lane's Book Nook on BPTV.
Is your body holding you back?
I want to go running. Not with that knee, you're not. I'm fine.
Fight for your mobility. Visit anationinmotion.org. A message from the American Academy of Orthopedic Surgeons.